Hi everyone. So today is our second lesson of strategic financial management. So before starting on with the session, I thought that I should go through the module specification by OTHM so that you all can understand the go through the learning outcomes with me and to see what areas um, you need to kind of be really thorough with, or kind of like what is expected from y'all. So as you can see, we have the OTHM module spec. I've shared it with you now. So when we look at it, so the fourth unit is strategic financial management, which has 20 credits. And I'm just gonna show you I'm just going to kind of go through with the learning outcomes and lesson outcomes so that you all understand what is expected from you. So as you can see, this is the section which talks about our unit, strategic financial management. And if you look at the unit aims, it says the aim of this unit is to develop a learner's understanding of planning and managing the use of organizations' financial resources. So like the learners will understand the importance of attaining business objectives and maximizing shareholder return. And learners will gain a working knowledge of business strategy design and the production of comprehensive business plan. So basically, this is a strategic financial management module. This is not necessarily not necessarily kind of like a accounting module. Actually, it has a lot of management related sections here. So you can see one of the main aims is to, help the learners for all to understand how to plan and manage the financial resources. That's one of the reasons that we started with resource and kind of moved on with what types of resources that a company has. That is what we did last week. And today we are kind of and we also spoke about how the resources are allocated. And today we are going to talk about how these allocated resources can be controlled. So that is very important to kind of understand how those can be controlled. So in line with the aims, we will be covering those. And now if you look at this table, the first section talks about the learning outcomes. So we have actually 5 learning outcomes. And then the second section is the assessment criteria. And then the third will have the indicative content. So when we look at the learning outcome, so the first learning outcome actually talks about understanding the significance of strategic management and decision making to the performance of a business organization, right? So this basically talks about how strategic management decision making will kind of help in performance of a business organization, where, as you can see, it says that you should be able to apply relevant theories and demonstrate an understanding of internal, external organizational factors, and then to evaluate resources used to meet organizational objectives. So basically, one thing that you need to understand is the lessons that I have planned have actually a mix of these learning outcomes when we are talking about it. So certain areas, yes, we will cover the whole learning outcome. In certain lessons, we will be covering sections of one learning outcome while, covering the other section of the learning outcome in another lesson. So example, now evaluating the business resources used to meet organizational objectives, certain sections are actually covered today, but another certain section will be covered kind of like later on as well. So, and then the second section is to understand key financial theories. Like, so basically you should be able to understand key financial theories and apply these on decision making, and also assess strategic implementation techniques using balanced scorecard. So now the second, and portfolio management tool. So you should be able to understand certain key theories. As you can see, we will probably be doing on the next lesson or the lesson after. So you will be talking about different financial theories and then how strategic implementation techniques are used. So basically today we do a little bit of strategic implementation. However, the area related to balanced scorecard, we will be probably doing in the lessons to come, because we have a specific section with balanced scorecard, which will be covered as well. So thereafter, we are supposed to talk about, the third learning outcome is to be able to apply stakeholder analysis and corporate evaluation technique. So first, there should be a way the significance of the stakeholder need to be identified and analyzed, and also like say different business expansion methods and stakeholder analysis need to be kind of analyzed, and return and risk needs to be computed, and the concept of corporate valuation is kind of managed. So basically this particular learning outcome is more towards business valuation actually. So it's like when a business expands, how do you value? Like if there is a merger or it's so there will be certain concepts that will be taught. The EVM method, MVM method, those are kind of like will be used to understand the value, like asset values, stock market cash flow, dividend valuation are certain ways that we will be using to do the corporate evaluation. So basically this particular section will be more focused on business expansion and how a manager should kind of try and manage, figure out how to expand and figure out what to do while expanding in a financial kind of perspective, and how to make that decision. That is how we will be doing in the third learning outcome. So when it comes to the fourth learning outcome, the fourth learning outcome says to understand the role of culture in strategic decision making. So generally, culture is something that you would just talk about in strategic management. However, now, because we are doing strategic financial management, now the role of culture in creating a strategy and how now the stakeholders, especially one of the main areas that will be covered would be stakeholder analysis, and kind of try to classify people who will influence the business. Because as you know that when we were always talking, we always say, okay, certain sections such as the shareholders are very important and more influential to the company's decision making. So they are the stakeholders who have a lot of lot of value, and those who can influence the company's decision making, while like the communities also do have a certain level of influence, however not as big as the state shareholders. So this would probably be related to how stakeholders are evaluated and how to identify what to do and what influence to kind of measure and see which one will affect the company's profitability or expansion. So those are things that will be spoken here. And then the shareholders perspective on Like here we will also be talking about the role and the effect of culture on a change management. Like when there is a change due to a merger in an acquisition. So change management sometimes is mainly talked like under, let's say generally we talk under maybe strategic management. Sometimes it's under HRM, change management, and you talk about different theories. But how a change management or merger and acquisition would affect an organization in a financial kind of perspective. So that is something that we will be talking about in this particular, let's say, unit as well. So then the last learning outcome is to understand performance measurement system. This is basically one of those areas where you do a lot of sums. So you will be evaluating performance measurements. As you can see, we'll be doing investment appraisal techniques such as payback, discounted payback, ARR, NPV, IRR, like the risk appraisal project. And also here, we will be talking about the sources of long-term finance, such as, okay, the sharing, shares, the borrowings and lease, grants, high purchase, just a small idea to kind of figure out what these sources are. Thereafter, we will also be doing the performance analysis related to ratios. How, especially related to 5 types of ratios, which would have liquidity ratios, profitability ratios, investor ratios, the efficiency ratio, and performance ratios, and how that will affect an organization's performance, and even how it will affect the organization's decision making in using a financial perspective. So moving on, as you can see, the assessment is mentioned. So you should have at least some type of understanding. And then you get the indicative reading list, where the textbooks that you can refer is included here. You could just kind of go through those and see, because that reading through sections of book would kind of help you understand the concept better. And you get, there are 2 types of journals that you can refer, and even websites obviously very easy to access, where you can just go through the website to kind of like understand certain sections where like real-time data, or like information about what's happening in the world, in the business world, which will kind of make you relate what you learn in this lesson to a business kind of a perspective. So at this level, you're a level 7 student. So obviously what is, you're supposed to be really good at relating what you learn in a company perspective and in a business perspective. So that will kind of, going through all this will kind of help you to really relate what you learn to an organization kind of perspective. So now moving on. So as you can see, moving on, we are just, so last week, so we'll start with the continuation of what we did last week. So last week we talked about organization resources and how it can be allocated effectively and efficiently. And now why we started with allocating resources, because it's one of the main aims of it's one of the main aims of our right. So one of the main aims of this particular unit, so therefore it's very important to just understand what the resources that we have and how they can be allocated and controlled. So now today's section will talk about controlling the resources, efficiently and effectively. So moving on, in order to control resources efficiently or effectively, one of the main methods that an organization uses is called budgeting. So now what is a budget? So budget is generally a kind of like a quantified plan for like the coming year. This is a plan which the organization is aiming to achieve, which will have, and it would kind of have a set target, how the resources of the organization are supposed to be allocated. And it would say, to achieve this target, these resources will be allocated in this manner. So the finances, especially when it comes to the financing resource, it needs to be allocated properly and managed accordingly. So by using a budget for the forthcoming period, an organization actually knows how much cost that they are going to incur, at least approximately. And they also have like a yardstick which they can plan on when it comes to each budgeting section. So looking at the objectives of budget, now one of the main objectives is for planning for the future. So in line with the objectives of the organization, it is very necessary to ensure that the objectives are achieved and planned properly for the future. So second objective is to control costs, like by investigating the differences and trying to identify the gap and reason for the gap. And so generally, so what happens in a budget is you do have a planned cost according to the budget. And after that, when the expenses are incurred, the actual and the budgeted amount is compared. So when you see a gap in between, so if the gap, like let's say the actual cost is higher than the budgeted, then that particular gap or the amount that has increased is called like generally the word that is used is variance. So you say adverse variance if the cost is more, and if the cost is less, then you call it a cost. Like if a cost is less, that means it's good for an organization. So then you call it a favorable kind of variance. So that's how the costs are kind of controlled. So if there is adverse variance, then the strategic management or the management will kind of try to figure out what went wrong, why there is a difference, is there anything that can be changed, and that will be included in the next budget. So this is a very important method in order to mitigate the cost of an organization and to plan effectively and efficiently. Plan the financial resources efficiently and effectively. Now, the next objective is coordination. So in order for management, like every department managements are kind of working towards a organizational goal. So there should be some kind of coordination between these departments. So this budget will help all the departments move towards one objective. And because it's a budget and everyone is allocated a certain amount, so there won't be any miscommunication, and there will be better coordination among different departments. So budget helps in coordination, and lastly, it helps in communication as well. So when managers are formally informed about their responsibility to achieve their targets, then obviously those managers will try their best to, achieve that particular target. So which will kind of be very useful for an organization set up, because all the management all the managers with the targets would try to achieve their target, which will be very beneficial for the organization in the end. And this will kind of help to reduce the gap with in the budgets. Moving on, so if we just looked at the budgetary control cycle, what happens is, this is basically like the process where the actual results are compared with the budgeted amounts, and try to investigate these differences and why these differences happen. So first, what is done is the budget amount is kind of agreed, looking at all the departments, and different budgets are actually prepared. I don't want to talk too much and confuse you. Like each department, there is a sales budget, there is a production budget, like that. You get a lot of functional budget. So all these functional budgets are prepared. So initially, the budget amounts for each section will be agreed upon, and after that, generally the expenditure is kind of incurred. Okay, so what happens after that would be that the management will look at the budgeted amount, then the actual amount, and the difference between this budgeted and the actual will be identified to see how much variance is there, and thereafter they will also try to figure out why there is kind of like if there is a high variance in certain section, they will try to understand why there is a high variance, right? And the reasons for differences are kind of thought, followed by, and then it will be followed by appropriate management action. So if the management feels some expenditures are mismanaged, that will be kind of given in as feedback for the particular section or department. And also if there is certain acceptable reason for the budget to increase, like let's say like price of certain let's say a raw material has increased due to taxation, which is important, is kind of increased due to some kind of taxation issue, then that means obviously it is not something that the management can manage. So then that increased price will be included in the budget, the next budget. So as you can see, this would be like a continuous process where after sorting out the differences and if there is something which is mismanaged, it will be kind of communicated to the relevant parties and told not to manage it, and just try to stick to the proper amounts, and thereafter a new budget will be agreed upon, and then again the agreed budget will work. So this will be like a continuous process in a company, and which will be like a process which will be very important in controlling the resources. Moving on, I'm going to talk about different budgeting methods. You have different budgeting methods. One is the fixed budget, or like the simplest form actually, where there is an original budget which is compared with the actuals. And then, as I said, the difference will be identified, and the actual, this difference, sorry, this difference will be considered as variances, and it can be adverse and also favorable. So I explained to you, if it's like an income, favorable will be when the actual amount are high, and adverse will be when the actual amounts are less. And when it comes to expenses, favorable variance would be when the cost is reduced, and adverse would be when the cost is increased. Okay, so now next would be the flex budget. So the budget generally, this kind of budget generally identifies the behavior patterns of activities, and this is designed in order to change as the volume of the activity changes. Now example, now talking about activity changes in volume. So budget, so now let's say I'll just give you a small example, not exactly, I just can't say that this is really relevant, but if you just look at like an apparel sector factory or something, when they're budgeting, they would probably budget like for, let's say, example, 10,000, cost of 10,000 dresses that have been sewn. So that is based on the general amount of different requirements. However, let's say there is a new client and the new client was 20,000. Okay, at once a new client comes in. So how do you make a flex budget to it? So what they do is, now this particular 10,000, there's a cost for the 10,000 dress units, and there will be a flex budget based on the volume of the activity. So basically there will be a budget which will be prepared for 20,000, where variable cost will be included according to the volume, and when it comes to fixed cost, that will obviously be kind of managed within all the divided among all the 20,000 dresses. So there will be a flex budget that would be kind of prepared in a situation like that. So then there are rolling budgets. So what is a rolling budget? This is basically budget where the budget is updated at the end of every month. So at the end of every month, the budget is looked at, and then what happens is whatever variances are identified, issues are identified and included, and then that particular month's budget will be that would be kind of identified, and after that will be taken off, and a new month will be added at the end. So end of the day, there'll be at all times there will be a 12 months budget plan. And the good thing about this rolling budget is that organization doesn't stay for like 3 months, 6 months, or like 1 year in order to identify the changes or variances in whatever budgeted resources are, but this is kind of identified each month. So basically whatever is relevant will be, if there's any mismanagement, it will never continue, because when it happens in 1 month, then obviously the second month, during the other month, it will be kind of updated in the new budget plan of the new month, and also kind of that will be looked into in the coming months and kind of manage as well. So that means rolling budget is actually very effective, because the management doesn't stay for 1 year to take action for any type of wrongdoing. So it will be happening every month, and it's good for in a corporate perspective, because that shows that the resources, the financial resources are managed really well. So moving, yeah. So after that, I will be talking about incremental budgeting. So what happens here is the previous year's budget is adjusted to cover like inflation and any other changes with the management expects. And this approach is generally quick and is like reasonably fair for stable companies, because it kind of increases, because obviously inflation happen in a business organization, like a business environment. So organizations need to adapt to it. So incremental budget happens that way. And now zero-based budget. Now what is zero-based budget? This is where the previous periods are not considered at all. So budget is generally prepared for like a cost center, and from scratch, based on the activity and the justification a budget is prepared. So that is why it's called zero-based budget. The last one is activity-based budget, where the budgeted figures comes under each financial function, where the activity of each function will be decided and the resources are allocated accordingly, and the variance will be identified according to the budget. So those are the different types of budgeting methods. And if you just look at the budget process, it has to be handled properly in order to achieve a particular target. And when you're participating in preparing budget, there are two specific ways that I use. One is called top-down, where the budget is generally prepared by the top management, and then the subordinates or the lower level is kind of informed, and they have to work towards it to meet the target set in the budget. But there is another method which is also called as bottom-up, where subordinates or the people who actually work on it also participate in their own budget, and then that's how the budget starts, not from the top. Thereafter, we'll be talking about setting targets and the motivation. So targets should generally be set at higher levels and employees, so that the employees are motivated to achieve them. So now when we set on targets, if it's too high, then obviously the employees will be demotivated and will not be able to perform on it. However, so now we're trying to try and understand what a good target is, right? So when this target is generally agreed by divisional managers in advance, then it would be a good target, because the divisional manager would obviously know what is really needed, what is achievable, okay? And it has to be measurable. Obviously, there should be some kind of yardstick saying, okay, you increase to a certain extent. This is the target that you are supposed to increase. And then there should be rewards and penalty. This is very important, because in order for an employee to try more or get motivated, there should be some kind of reward, or there should be a penalty where they are kind of motivated to kind of achieve that target, because they know if you achieve that target or try to achieve it, go near it, what happens is they know that they will get some reward. And also, if they do not get to achieve it, what happens is there'll be penalties involved. So that means they'll be scared of the penalties, so they will try their best to kind of achieve this particular target, or try to come somewhere near the target. So then also it should be goal congruent, and it could also be dependent on factors controllable by the managers. So that is what a good target would be. So then also there's something called responsibility accounting, which comes in with target setting and budgeting. So where the managers should be able to be held responsible for not meeting the target. So there should be some way where managers are held responsible, so that the organization can ensure that the targets are properly met. And management by objective, what does that mean? Like emphasis on preparing budget would be on achieving certain objectives. So objectives are generally set and prepared by an organization, and based on those, the budgets are kind of prepared. So that is by what is meant by management by objective. So next, we'll be talking about budget control. Now, what is budget control? This is basically controlling the actual performance in line with the budgeted through like a continuous comparison. So that is the budget control. That is, I explained to you about the process, right? Where you keep a budget, then you look at the like actual figures, then compare and try, and if there is some kind of mismanagement, you kind of go and meet who had mismanaged, and kind of explained to those, those relevant people that those expenses have to be controlled. And so then through that, I said that process keeps on continuing, and that is this continuous comparison kind of really helps in controlling the budget. So looking, now we are trying to see what the objectives of having a budgetary control is. So it is basically, the objective is to have a detailed plan for like a definite kind of period. So you know what you're supposed to achieve within that specific period. So, and also it could be used to achieve a specific maximum return on a minimum investment. So this budget will kind of help an organization to effectively manage the resources in order to achieve a maximum return, so which is very good. And also it assigns responsibility to identify the direction. Now it will help to identify the direction and target for the direction. So next, now we are talking about the advantages of budgetary control. So generally the responsibilities are generally clearly identified here, and all activities which are linked to one final objective will be included, and generally the finances will be planned. And also it helps in smooth operation because you know what you're supposed to achieve in that specific time period. So it will help all the department to move on with their activities in order to achieve the objective. So when there is a budget, also there will be no excess stock, or situation where there is no stock, because it's budgeted for, and the process works smoothly. So yep. Now we are moving on to strategic planning, and let's see what strategic planning is. So strategy. So before talking about strategic planning, we need to understand what strategies. So strategy is generally like a long-time direction, or kind of like a scope for an organization, which needs to be achieved to to achieve the vision of the company. So if you look at Johnson and Gulf, they're like very like the most important people that we talk about when we're talking about corporate strategy. They define the corporate strategy as the direction and scope of an organization which achieves advantages for organization through configuration of resources within a challenging and dynamic environment to meet the needs of markets and to fulfill stakeholder expectations over the long time. So basically what a corporate strategy means is like it's kind of like achieving, so kind of like trying to achieve the maximum out of the resources that the organization has in the challenging dynamic environment, while trying to meet the needs of the markets or the stakeholders over the specific long time period. So strategic planning, we need to understand, is like a long-term planning, and it's also called as corporate planning. So now let's see what are the characteristics of a strategic plan. So all stakeholders of an organization are considered here. Sorry about it. So then the strategic planning generally gives direction to the organization and synchronizes its activities. And it also looks at how to gain a sustainable competitive advantage and considers the internal as well as the external environment. Also, it relates to the organization, its resources and competences to its environment as well. Okay, moving on, we'll be talking about the advantages of strategic planning. So what's good about having a strategic long-term plan? It generally improves the organization bond with the environment. It helps the organization to kind of look ahead and allows the maximum utilization of the scarce resource, and also provides like a strategic direction for the business and its operations as well. And it also monitors the progress of the organizational operations, and it ensures value creation by like minimizing the risk and also trying to exploit the opportunities. Now, disadvantages, we don't have too many disadvantages identified. Sorry. So it is, the disadvantage is that there will be a possibility of having a developing a bureaucracy and also less relevance in a crisis. So if there is a crisis, obviously the strategic plan will not be considered. We'll just the organization might need to just work around the crisis and try to kind of achieve the short-term kind of objective, not the long-term situation. So that's why it's an disadvantage. So then we are going to talk about why strategic planning is important. So there's always going to be like a high capital expenditure, and so it's very important to plan ahead. Sorry. And there will always be like long lead times, and even there'll be a lot of stakeholders who are affected by whatever the organization does in a long run. So the organization needs to plan ahead for a long term, have a proper plan and say what they're trying to achieve. So strategic planning is very important, therefore. So the business also needs to, like, the business also might need to be turned around. If that is so, obviously there should be a proper plan. And when there is a situation, the business needs to look into new acquisition or even expansion, then planning, having a strategic plan is very important. Okay, so these are the situations when the strategic planning is very important, as you can see. So moving on, we'll be going to the last section of this particular topics that I'm talking about, which is to identify and develop strategies for the resource gaps. Okay, so now how do we identify resource? So it's called resource gap analysis. Before talking about resource gap analysis, we'll try and understand what gap analysis is. So gap analysis, so gap analysis generally looks at the existing state of the market or the product, and then compares it to the target level of performance. That is the gap. So existing one is compared with the target level performance. So now, what is resource gap analysis? That is this, basically it's obviously a subset of gap analysis, which like focuses on the resources held by the company or the organization, the current level, and how much the future needs, like how much the current levels are, and then compared to it to the estimated future needs. So the gap between those two is the resource gap analysis. So basically, resource gap analysis examines the gap between the current resources and the resources that is needed in order to satisfy the future need of the organization. So, right, moving on. So we'll look at a situation or perspective in which gap analysis kind of happens. So generally it happens in an organization. Like, let's say example, human resources, where example, like we'll be looking at, sorry, excuse me. So we will be looking at the current workforce that the organization has and decide, how much workforce or human resources are kind of needed in order to do all the future needs. How much is the desired human resource amount, and then the gap is kind of identified. And then it could be based on business direction. Okay, what is the current direction of the organization and what is the desired kind of state? So, and then this difference will be identified as a gap. And then even it could be the business process where the process that the organization uses, if it's not the most new, if it's not like the novel kind of business process, so then the current practice and then the desired practice will be compared, and then and the gap will be identified in order to see, okay, what can be done to achieve that particular desired end state. And then it would be information technology. Example, just because there's something that everyone knows, I just thought of taking this as an example. So as you can see, gap analysis happens where there is a current practice and then there is a desired end state and then there is a gap. So information technology, as in, okay, current practice, we can just look at an organization which has a normal internal kind of ERP. So that doesn't mean, it shows that the organization does have, some kind of information technology involvement in there. But the desired state could be something like ERP, which is in the cloud, where all the departments, or if the company has different, let's say, different branches in different countries, but they actually can input everything to the cloud, and in real time all the reports can be achieved. That is something that is happening here now, like in the present business environment. So if that is the desired end state, the gap will be identified, something like, including cloud computing into the ERP system, and then methods in which this gap can be reduced needs to be identified. That is how this financial gap or resource gap is analyzed. So now we'll be talking about usage gap. Usage gap is actually the gap between the total potential and the actual current usage by all the customers in the market. And it is generally, as you can see, used as market potential minus existing usage. So market potential is like the maximum number of customers available. And this is generally derived through like a research or like using demographic data or the government statistics. And when it comes to existing usage, what happens is the market comprises from existing usage, and the market share is kind of calculated. So the difference between these are used, kind of identified as the usage gap. Moving on, we are going to try and understand the process to develop a gap analysis. So for that, I'll just take that information ERP example. So identifying the existing process. So, okay, you identify that you have a particular ERP, and then identify the existing outcome. So the outcome could be, okay, that using the ERP, you can get monthly or yearly accounting statements and things as such. So identify desired outcome. Like example, the ability to get daily reports, where whenever possible, just to get to the reports of income statement, or let's say balance sheets or something, daily, whenever you want, in real time. So that is a desired state, and identify a process to get the desired outcome. That would be something like identifying which cloud computing method can be used in order to kind of incorporate with the ERP system that is currently in process. and then the document the gap. So obviously the gap is kind of documented, and remedies to reduce or eliminate the gap is identified. Now it's like this: just because there is a identified desired outcome does not mean an organization needs to kind of allocate all their resources towards it. So our organization need to manage according to their ability. So sometimes they might be able to kind of include, you have to look into how much cost or resources, the financial resources needs to be allocated in order to have the desired outcome. But if it's obviously difficult at the current state, what can be done is there could be steps that is the organization can look into steps which can be used in order to reduce this gap. So have a plan where they can try and slowly kind of step-by-step plan with they're trying to kind of achieve this desired method slowly. So next, we are going to talk about workforce gap, where it is basically the difference between the proficiency level or the competency of any member or segment of the organization, the workforce. This difference between the level of proficiency identified in each competency is generally called as workforce gap. Then we will also be talking about sorry about that. So the organization needs to ensure its resources and competencies, and it should be understood and evaluated to implement a specific strategic plan. So it should generally be the resource gap, and organization should try and ensure it and try and realize it as well. So now we are going to talk about something called strategic resource gap audit, actually. So this generally helps an organization to identify the resources which are available in order to carry out its operation, and they can be owned by the business, or they can even be through partnership or joint ventures. So what resources that the organization have in process to carry out its operations, that is the identification through strategic audit, resource audit. So an organization can define its strategic capabilities through resource audit using historical analysis, where the organization can verify on how the resources are deployed or changed over time. And another way is industry comparative analysis, where you compare the resources and capabilities of the other competitors in the industry. And the other one is the best practice benchmarking, which is the resource capabilities are compared with the best in the industry as well. So next then we will be talking the last section, which is the resource audit that identify the resources of an organization. So basically, the resources should be owned according to the substance over form. And by performing generally these resource audits, what happens is the company will be able to identify the resources which are necessary for that particular period. So as you can see, before we spoke about how it is identified, that is using a historical analysis or using industry comparative analysis or even the best practice in benchmarking. So in that way, the organization try to identify the resources and see how much they have their own and how much they can kind of allocate when it comes to resources, and then try and use it to get a utilize it according to what they can and try and achieve the target that they are supposed to achieve. So so in a resource audit, following can be identified as a resource audit. So there are 4 sections, where one would be the human resource audit. So can you remember in the first lesson I talked about 4 types of resources? I said there is a human resource. What we do is do a count of the human resource. That is the auditing of human resource. So that is what you call as human resource audit. Then there will be a physical resource audit, where the physical resources of the company will be kind of analyzed and see how much physical resources that the organization has, like, do a proper count and see how much resources the organization has. So that is a physical resource audit. And then there is a finance resource audit, where the financial assets or sections of resources will be tried and accumulated and kind of set and checked to see how much financial resources the organization or the company has. And lastly, it will be intangible audit. So obviously the company would check what are the intangibles that the company has, and how audited can see how much they are valued. Those are things that will be kind of utilized. So as you can see with this, we have come to the end of this specific PPT or the lesson that I've prepared. So before moving on, I thought we'll just kind of do like a small recap of what we did during last session and this session. So if we just talk about what we spoke. Hold on. Okay, so first we talked about organizational resources. You obviously know why it's very important for us to identify organized resources, because one of the main reasons is for you all to be able to kind of identify ways in which the financial resources kind of manage. So here we are not only focusing on finance, we are also talking about the others, so that you get a better understanding. So we try to understand what organization resources are, and then we talked about the 4 types of organization resources that any company has, where we spoke about financial resources and see how a business is generally financed, and I kind of talked about how it can be short-term, medium-term, or even long-term sources, and how these these are kind of managed. And we also talked about how how the financial resources are basically the capital requirements of the company. So the short-term capital requirement would be the working capital, long-term requirement would be like anything kind of like a non-current capital. And then we also spoke about human resource, and I explained to you that it is considered to be like the backbone of any organization, because without the human resource, none of the other resources can be managed. So even if you have financial resource, obviously without the human resource getting involved, obviously it cannot be managed. Yes, finance resource is very important for an organization, but in order to effectively manage anything, the human resource is very important for any company. So thereafter, we spoke about intangible resource, where I told about how a company brand name will be very important. Like example, I told you about different places like Charles and Keith, and like, example of McDonald's or Burger King, where when those companies expand to another company and keep a branch, obviously due to this brand name, the customers do come in due to the intangible resource of brand name. So I spoke how that will help an organization, and then about the physical, obviously the tangible resource, where we talked about the long-term assets that we generally include in a balance sheet, like the land, building, machinery, inventory as such. And then we also talked about how these resources need to be allocated efficiently, and how this resource can be allocated in short-run decision making, where we spoke about relevant costs and sunk costs and even like opportunity costs. Then we talked about long run. How can those be managed? And I talked about few factors which can be used And thereafter, today's session where we talked about controlling. So we kind of immensely spoke about budgeting, because controlling, in order to control, it's very important to have a proper budget. And we kind of explained about different methods of budget, the budget process, and then we spoke about how participation can be included in a top-down method or bottom-up method. And we spoke about how a target can be set and how we set actually a good target. And talk about how the responsibility accounting happens and management by objectives, and how the budget can actually be controlled. Then we talked about the advantages of actually having budgetary control. And then we moved on to strategic planning. We spoke about what strategies and the characteristics, then the advantages and disadvantages, and why strategic planning is very important to any organization. Thereafter, we try to identify and develop strategies for resource gaps. So we spoke about first, before talking about resource gap, we spoke about gap analysis, then resource gaps. And then we also spoke how the current practice decided instead kind of identified, and then the gap is using an example. I just showed how the gap is identified and how the organization can try and move on to getting, move on in trying to achieve the desired state, at least in a step-by process. Then we spoke about workforce gap, and then strategic resource audit, and how this can be identified as well. So I just hope that all of you understood what I explained, and you have a better understanding about this section. Sorry if there was any interruption in between, because I'm unwell these days, and I hope you have a nice day. Thank you.